afternoon, everyone. My name is Knox Henderson. I'm Investor for Relations with Great Bear. Today, we're talking about why invest in mining exploration. Our host is Greg McCoach from the Mining Speculator. Before we begin, just a little bit of housekeeping. Greg will lead our discussion of some of the market commentary that Chris and Chris want to provide. Then we'll look at some common themes between the two companies. After which we'll have a Q&A. We welcome your questions. There's a Q&A button on your screen. If you don't see it, just roll your cursor to the top of or the bottom of your screen and it should pop up. You can ask the questions as they're going, and at the end, we'll collect as many as we can cover at the very end. And also, if we don't get all the questions, which is we probably won't, there'll be some contact information on the last slide. And just a little bit of a quick disclaimer. This webinar is hosted and recorded by Great Bear Resources Limited and SilverCrest Metals. All opinions expressed do not reflect the opinions of Great Bear or SilverCrest or any of its affiliates. This call is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for an investment decision. Investors are encouraged to perform their own due diligence and to seek the counsel of a professional registered investment advisor before making any investment decision. So with that, I will pass the baton on to you, Greg McCoach.
Thanks, Knox. Well, welcome everyone to our webinar. As Knox said, my name is Greg McCoach, editor of my newsletter, The Mining Speculator. I'll be your moderator today for the webinar, which is on investing in the mining exploration sector. Joining us today are our two panelists, President and CEO Chris Taylor of Great Bear Resources, which is a high-grade gold story, and President Chris Ritchie of SilverCrest Metals, which is a high-grade silver gold story. Gentlemen, welcome to the panel.
Thanks for having us.
Very nice to be here, Greg.
Yeah, good to see you guys. And it just seems like we're in a new virtual world now, and we all have to learn how to use Zoom. So it's for me, as a road warrior, traveling as much as I do, it's a welcome change for me. So how do you guys feel about it?
I'm actually happy to see my wife and kids for a while. I don't know how you feel, Chris, but all the conferences and marketing that we generally do, I had some pretty serious premium privileges with the carriers, right? So right now, I actually get to see my kids, which is, I can't really complain.
I hadn't been home more than 1 to 2 weeks a month in the last 10 years.
Wow.
After the first month of COVID, that was the longest I'd been at home in 10 years. So after 3-4 months, I'm actually settling in. It's actually great.
So, and how's everybody? Are they like, oh, now I know what Chris is actually like?
It's great. Yeah, it's fun. So unfortunate for everybody else, but I enjoy being home for a bit.
Yeah, we're embracing the technology, I think, all of us. So today's panel discussion will take place over roughly 45-minute time period, and we'll leave 10 to 15 minutes at the end for a Q&A session, which Knox will send us the questions you send in, and we'll answer them in the order we took them in. This panel is an educational panel designed to help the lay investor understand the terrific potential currently to buy low and sell high in the exploration sector. And with that said, I'm going to give you a general outline of where I think things are at in the precious metals mining sector. Precious metal prices, gold and silver both appear to be poised to have major breakouts to the upside in the weeks and months ahead. Gold and silver are trading at gold and silver stocks are trading at extremely low values compared to where many believe the stock prices could go. So why is this happening? Well, just a couple bulleted points before we get into the macro slides of both of our panelists. I believe it's happening because COVID-19 was a pin that pricked the bubble markets that have been created. And this has caused real damage to the world economy, and the consequences of which I think were going to be felt for years. Second, the bailouts and stimulus that has occurred because of COVID, which in my view is unsustainable, can never replace our lost economy. This is a big factor in why safe haven precious metals is really becoming of interest to more and more investors. The third point I wanted to make is that gold is moving up worldwide against all currencies. This is this is all happening at the same time. As this is going on, the US dollar is showing signs of real stress to the downside, as the US government debt is just escalating as it's never escalated before, and Fed money creation is completely out of control. So these are very troubling signs. Where this is going to lead, again, it looks very good for gold. Also, once the stimulus stops, as it can't go on forever, it appears bankruptcies and unemployment numbers could be staggering later this year or sometime in early next year. And with all this money creation, this stimulus is different than what happened in 2008. That money was basically kept in the in the banking sector. It didn't spread out into the general economy. This time, the money is out in the general economy, and I think it's going to be hyperinflationary, which again is good for gold. So with all this taken into account, it appears safe haven gold and silver prices, along with quality precious metal mining shares, are grossly undervalued at current levels and getting ready for an epic run to higher ground. With that being said, Chris, that's a segue into your macro slides and where you think the opportunities are.
Thanks, Greg. If you can switch to the next slide, Knox. This chart was given to us by a gentleman by the name of Donald Smith. And Donald Smith has since passed away, but he was trained by Benjamin Graham. And Benjamin Graham, we all know, is trained Warren Buffett. So what the GSCI stands for is the Goldman Sachs Commodity Index. So this chart shows a basket of commodities. So gold, silver, copper, agricultural products, oil, and it's comparing these hard assets to financial assets. So it's a basket of hard assets versus stocks. And again, as you can see, it goes back to 1971. So in the last 50 years, you have not seen commodities this cheap relative to the broader market. So we all saw the run up pre-global financial crisis. You know, oil was $120 a barrel. Copper was over $4 a pound. You know, gold was much higher, 1800, 1900. So we've seen this before, and they're called cyclicals for a reason. So from a valuation perspective, to Greg's point, we have not seen commodities this cheap in 50 years. So from a value investing standpoint, this chart's quite significant. Next slide, please. Now, if you strip out the commodities and you just try to isolate gold miners in general, this is a chart that compares gold stocks or precious metal stocks to the S&P. And again, I love just looking at different time frames because it tells a completely different story. In the investing world today, people are working off 15-minute increments. You know, I have people saying, why is your stock not performing well right now? And I'm kind of going, whoa, okay. If you go back 2 months, you know, 3 months or a year or two, it paints a different story. So you can see here over the last 25 years, again, we're very much near the bottom of where we are. And you can still see in that little blip in 2020 that we have had a really strong move in precious metal stocks. But again, if you compare that to the potential or the size of that previous rally, it really hasn't even started. So again, it's just for context, you know, and the generalist investor or people that are just entering the space, to look at some of the charts today, it's quite intimidating. But again, to look at a chart like this and take a step back and realize that all the macro events that we've seen, or, you know, cycles that are over 20, 30, 40-year views, this could have been just the wake-up call as opposed to the finish of a cycle. Next slide, please. So to tie with that, the chart on the left here is fund flow, because momentum and psychology obviously have an enormous impact on where money goes. Right now, we're within near all-time highs in terms of price to earnings ratios, but the earnings portion of that is totally unclear. So here we are looking at inflows and outflows towards precious metal stocks for the last decade, and you've seen nothing but outflows. So these gold funds have been nothing but selling. So you get to a point where we're at decade lows or multi-decade lows in terms of valuations, and at the same time sentiment is at multi-decade lows. So again, it's pretty washed out is the point to see in the left. And on the right side, what you can see from the Huey is just a gold index, and there's multiple charts you can look at this, but if you add up all of the market caps of gold stocks, you're roughly 1% of the global stock market. So it is tiny. So if that 1% went to 3, I mean, that fund flow that would drive into the space and the movement you could potentially have for the gold and silver stocks would be parabolic. And the beauty of the cyclical stocks is if you are seeing increased gold and silver prices at the same times, the stocks are getting cheaper at the same time. So this positive snowball effect that has the potential to happen. So the macro setup is quite enticing right now. Next slide, please.
Yeah, well, Chris, this is one of the most important slides, I think, when people are looking at the overall investment scenario. And frankly, I think the general market doesn't realize that the value of all the companies in the Huey is about the same as the size of Tesla as a company. That's absolutely new information to the majority of investors. But I've seen the net effect during the last cycle of when that money begins to go into the space. And so have you. It's absolutely staggering what happens to the equity performance.
Yeah, it's amazing. So this slide is a little bit on the macro to Greg's point. And what this is showing is one of the correlations to gold historically. And the gold bars in the background here are real rates. So what real rates mean, for those who aren't quite aware, is you take the nominal interest rate, so just the headline interest rate, and you subtract the inflation rate. So you can see back 50 years here that there's been 5 times when that real rates are negative. And again, that means your inflation rate is lower than the interest rates. That's not hard to do right now, given that globally interest rates are pretty much near zero. And each of those times where that's occurred, you see the red line shoot up. And the red line there is the gold price. So with all the money that's been created, and with the amount of cumulative debt we have right now, you've got this setup that's quite fascinating. And if you listen to what the Fed said last week, they said, we're not thinking about raising rates. We're not even thinking about raising rates. And you just can't afford it. So moving interest rates from 1% to 2%, well, that's not just a 1% increase in rates. That's a 100% increase in your payments. And the economy right now just cannot sustain that if all of a sudden mortgage payments went up 100% or 50%. So the scenario where these rates stay this low for this long is extremely supportive for gold price in the long term. And again, we just got started. Next slide, please. This sort of speaks to what these various cycles can mean. And SilverCrest is a gold and silver stock. It's about 50-50. Great Bear is obviously more gold weighted. But it sort of speaks to the last big 5 cycles that we've had in gold and silver. And again, if you just look at the nominal numbers here on the top there, showing how much gold and silver moved in these various markets, some of them are pretty staggering. And again, we saw where we're starting from is near the bottom from a very long-term perspective. And you can see that for some of these periods of time, silver started out lagging, and then it caught up and accelerated. But either way, they're moving somewhat in tandem. Silver tends to be a little bit more volatile, but it just gives people a flavor for what kind of performance has historically at least taken place when things get rolling. Next slide, please. So again, I like looking at big picture stuff. So the chart on the left here is talking about money creation, and that's the red line, the blue line. And then the red line here is the value of the gold above ground. So again, if gold price is going up, it's relating to the quantity that's currently on the surface of the earth. So this is a 100-year chart. So you're more or less seeing that that's a pretty decent correlation over that period of time. So if the value of gold tends to go up with money creation, if you look at the chart on the upper right side of the page, look at that money creation. We just have seen in the last 2-3 months something that is off the charts. And those gray bars, those gray columns there, those were pretty big fundamental economic events, 2001 and 2008, 9, 10. And you can see the blips there when the government stepped in to try to do everything they could to fight off a recession or a depression. The money we're seeing coming into the economy now, it just dwarfs everything that's been done in the past. So again, we'll see what happens, but we're in weird times yet. And that pricking of the bubble that Greg spoke to, we just haven't seen that materialize just yet. And the bottom right chart is, to me, shows the science experiment of what's going on today. The same central banks that are printing the money left, right, and center are the same central banks that are buying gold hand over fist. So what they're essentially doing is hedging their own behavior. They know that what they're doing when they're destroying the value of their currencies, and I'm not, I'm saying that in a judgmental way. I would not want to be in their shoes right now trying to navigate what's going on in the world. But it just shows you that at the end of the day, there needs to be a store of value. And that can be in housing, that can be in copper, that doesn't have to be in gold and silver. But again, go back to the very first chart we spoke to, you can see that hard assets versus financial assets. That can be a broad category of assets to include, but it just gives you a feel that this is a really big long-term trend that is potentially just getting started. Next one.
Yeah,
Over to you, Chris.
Yeah, I'll speak to this one a little bit. And to your last point there, Chris, and I know we've talked about this before, Greg, but gold is the commodity that you really can't fake. You know, if you think of gold as a currency alongside other dollars, you can't create it with keystrokes in a computer, and you have to find it in the ground. And I think, I forget the metric, but it's something like about 99% of the gold that's ever been mined still exists and is held in the form of jewelry and bank vaults, or, you know, it's a very long-term store of value. So this is why I think one of the things that adds that element of stability. And I was asked a lot during the correction in March, for instance, this year, of, well, what would happen to gold? And the bottom line is, at the end of the day, you know, stocks, equities, everything else sold off really badly. Gold held the majority of its value and sprung back very quickly as that safe store of value. And it's something that the market intimately understands. Unlike new emerging products like cryptocurrencies, gold's been around for thousands of years. People know that it's real and they know that it holds value. So, but the chart that's in front of you right now is pretty informative in the sense that there's only two lines to look at here. The blue line here is effectively an index, the AUX. Now, this is about the equivalent in the gold space of the Dow Jones. So I think there's about 30 stocks that make up the AUX. So this is basically, it's a composite, much like the Dow. And you can see that its performance relative to gold during the previous bull market, on the left side of the screen going into towards 2012, we're in a bull market for gold. And what you saw was equities outperforming the price performance of gold bullion. And you saw that they traded in tandem a little bit after that, and then they began to decouple. And they're still exceptionally decoupled. If you look at the historical perspective, and Knox, if you could switch to the next slide. This is the full round trip over that same time period. The way to read this chart is the gold price of the AUX on the left side and the price of bullion along the bottom. And you can see that basically as the price of gold goes to the right, you tend to go up in terms of the value of the AUX. But what you see on this graph is really more of a Z pattern. It starts on the top left part of the screen, it migrates to the top right, goes back down to the top or to the bottom left, and then it's migrating upwards to the right again. And you can see that the different shaped dots represent the different years. What I saw when I was involved in the industry during this process in the previous cycle was what circled there in 2011. And this was the flight of generalist money. These are investors that are not specifically focused on gold or other commodities. When gold was pricing in at high levels, they began to exit the space. And once that money was out of the system, like was shown on Chris's previous chart, because the gold space is so small compared to other commodities, it tends to respond very strongly to the influx of new capital, or the, in this sense, the outflows of that capital. So you can see that the price of these gold miners collectively began to decline, but now it's beginning to recover. So you've gone down along the Z, down to the bottom left on the Z, and now you're beginning to go upwards again. The difference is that gold miners as a whole are very strong performers in terms of responsible mining, very good cash balances. And these are companies that in many, many ways are stronger entities to invest in than they were back in 2010, 2011. So right now, you're looking at companies with very strong balance sheets, very good cash flow. But to put it in context, right now, during the March correction, even though these companies have shown fiscal discipline, operational discipline, they were trading at an average of about 5 times their cash flows. Right now, in June of this year, they're trading at about 8 times their cash flows. During the previous historical averages, they traded at about 11 times cash flow. And during the previous bull market for gold, they got up to trading up to 20 times cash flow. And that means when you look at this graph here and you think about the historical averages, even if nothing else changed in the world other than reverting to the mean, these gold equities should revert to multiples of their current valuations if they go in line with historics. And Knox, I'd go to the next slide now.
And Chris, I'd add, if gold and silver go higher, those multiples will stay even lower and lower. So that catch-up trade can be compounded if gold and silver moves higher at the same time.
Yeah, that's a good point, Chris. And this slide actually speaks to this as well, in the sense that you can see on the left side around 2012, 2013, this is the all-in sustaining cost, AISC. So this is basically a graph showing you how much it costs to pull an ounce of gold out of the ground in a mine. And you can see that during the previous bull run, going up to 2013, the price to produce an ounce of gold rose pretty dramatically. And that meant that these companies, they had big debts, their profitability margins were being squeezed, and they really weren't great companies to invest in, but they fixed themselves. And you can see down around 2016, they got rid of bad assets, got rid of debts, began focusing on cash flow. And now here we are in 2020, and you're looking at lower average all-in sustaining costs than were at the peak of the last bull market. And this shows you, if you're a company that's making whatever it is, widgets, if now the cost to produce a widget is lower and the value on a per sale basis of a widget is higher, you're going to make more money as a company. And it shows you that now is actually a very good time to get invested in the mining space. And Knox, I think you can take it to the next slide now.
Okay, this is where I take over. Thanks, gentlemen, for that good information. I think as I'm listening to this, all three of us in unison are basically telling lay investors to sell overvalued bubble markets and buy undervalued markets like the junior mining space. It certainly appears that we're getting ready for some big moves. And another point that one of you made was with the fund money. I think that was you, Chris, Richie, that I've seen in my lifetime of trading these stocks and writing as a newsletter writer, that when we get into this super bull market of precious metal mining shares, whenever this has happened, it's that fund money. There's so much money that suddenly comes rushing into our sector. And all of us attend a conference, the Beaver Creek Precious Metals Summit, every year up at Beaver Creek, Colorado. And I always find that to be the most important conference I attend every year, because it's all these big fund managers, and they have huge pools of capital to invest in anywhere they want. And they know that the bubble markets have kind of hit their peak. We've already seen the risks to the downside and the corrections. But, you know, overall, the safe haven trade, they have no options other than to come in physical gold or precious metal quality mining shares. So I see that coming. When it happens, I want to let lay investors know that these stocks can go parabolic in that moment. And unfortunately, when they leave, it can go the other way. So good points, guys. These are really good things. And the other point I wanted to make was how precious metals really are. Let's just take gold first. If you took all the physical gold above ground in the form of jewelry, like Chris Taylor mentioned, bullion coins and bars, all the central bank holdings, you melt it into a giant cube. The cube only measures 30 yards by 30 yards by 30 yards. That's why they call it precious. It's a tiny market compared to any other market. And silver, which hasn't moved yet, gold's already made a nice move, but that's typical. Silver always lags and plays catch up, and I think it's about ready to make a big move. But silver's going to go from its status as an industrial metal to all of a sudden poor man's gold. So a lot of good things are happening here, guys, and I think we're all on the same page. So this next slide is I think, in all the years that I've tried to help lay investors understand how to play this market, this chart is the foundation for how you make money. And what this basically shows us is the value of the stock price going up on the left. And across the bottom, you see exploration, discovery, feasibility, development, and actually becoming a producing mine. So you see the two big blips, the two big opportunities to ramp up and make big money is when a discovery is made. We go along the curve, we start a company, we get our data, and all of a sudden the discovery is announced and the stock price takes off and it runs, okay? And it runs to a level where it finally peaks out and reality sinks in and, oh, maybe the stock ran a little too high, and then we correct some. And then we go through a development phase where, you know, the stock kind of goes back to a more normal level as we anticipate that, you know, it's going to take years to go through permitting, feasibility. And then there's this next big ramp up as all of a sudden investors realize, hey, there's going to be a mine, it's going to produce, it's going to be profitable, and we take off again. So these are the two greatest opportunities to make money. And I think the two companies we have on our panel are such excellent examples of having great success already in what's been a difficult market. Not too many stocks are performing the way Great Bear and SilverCrest metals are. And so hats off to management for you know, doing what needs to be done. And the next slide is going to go through what lay investors need to look for. What are the common denominators of these two companies? Why have they been so successful? And these are the models, in my view, of success that you want to look for. What they're doing, what they've done is what you want to look for in other companies that you may invest in. So with that, guys, let's take management first. Obviously, this is always the most important. In my view, it's the people behind it. We often refer to these things, junior mining stocks, as a horse race, where the horses are the companies or the projects, but the management is the jockey, right? And more times than not, you know, you might have the right project, but you have the right horse, but you have the wrong jockey. What say you, Chris Taylor?
Yeah, this has got to be the key. I think the success that we have is owed to the team that we've put together. And, you know, we have a great discovery. I won't talk about that, but the people have been absolutely phenomenal. They think independently. They have a lot of experience in the industry, and that means that they've learned from mistakes. None of them are raw graduates out of school. We've been around the block for many years. It's about 20 years now for myself. My partner, who we put Great Bear together with, Bob Singh, he's about 30 years in the business now. And we've put together good advisors as well. John Robbins, Jim Paterson are famous ones that are with the company. It's a good independent board. And I find the experience and the vision to think differently with the management team has made all the difference in terms of making the discoveries that we have and the ability to get the message out to the market.
No, that's great. Chris Ritchie, what are your thoughts?
I was an institutional salesperson for 13 years, and my job was to identify good teams and then take those good teams to New York, which was my coverage area, to find investors. And Eric Fear was one of those top best guys I've ever met across all industries. He's a geologist, a mining engineer. He's built 6 mines. He's discovered over 1 billion ounces of silver in his career. And he loves mining. It's his passion. And, you know, he built the Santa Elena mine, which is 25 kilometers away. And we live in the community. His thing is boots on the ground. And then since then, we've also added Pierre Baudouin as COO. And when he left Detour, that's the largest mine in Canada, he looked at about 30 assets before deciding where to go next. And then he joined here. So between that and Eric's kids, we joke that 2 of his 4 kids work with us, to say if Eric wants to see his family, he has to go to work. You know, to have 2 people and a whole team that's that passionate and very much on the ground, hands-on, boots on the ground, you can't beat that.
Yeah, Chris, it's worked for us too. We have our team lives in Red Lake, right by the project. Like, you'll never get happier people. We have a group that we work with called Rimini Exploration, and these are geologists that are resident in that district. And with the times when I used to work for a producing company called Imperial Metals, and one of my favorite projects was the Sterling property in Nevada. And I lived down there with my wife and my daughter when my daughter was a baby, and we put that thing into production. So that got bought by Core Mining recently, actually. But when you go home at the end of the day, after doing what you love all day long, and then you come home to your family and it's all right by the site, it's got to be one of the best recipes for success, because nobody's thinking about what they want to do on their time off. They're thinking about what they want to do at work the next day. It's a huge difference.
And it's big for costs. I mean, there's a lot of decisions to be made. And if there's a huge lag time between what's happening on the ground, back to management, understanding what's going on at head office, that just costs money every minute. And if you're there all the time to make those decisions in the moment, you're just way more efficient.
Well, you guys, Chris, this is a bit of a back and forth discussion, but how long does it take for a lot of your staff to get to the site, basically, every
45 minutes.
Yeah. We're within half an hour too. And it's incredible, cost efficiencies, personnel motivation. It's incredible to see a project like that. It's a problem in the industry is that we're a rare, both of our companies are rare examples. There's a lot of deposits around the world that are a real pain in the bottom to get to. They're up on a mountain, or they're in the Arctic, or they're in a jurisdiction that's not safe to work. We have benefited.
People don't want to go there.
That's right. We haven't had those problems, and it shows you that the cost efficiencies and the success come in when you don't have to deal with headaches all day long.
Absolutely, guys. Well, listen, we all agree that management is the most important factor when evaluating junior mining stocks, no doubt. Moving on to jurisdiction. Now, this is related to where is the project? Is it out in the middle of Timbuktu? Or is it near infrastructure? Both of you already made some of those points. So we understand that for a big major mining company that wants to buy out a new discovery, they would love to have all the roads, power, and everything already built. Everything's already there. They don't need to create it out of thin air and pay for all the infrastructure and all the electric power and things like that. So any other comments on jurisdiction?
I mean, you can rank companies around the world based on, the political risk of the jurisdictions that they operate in. But even beyond the typical political risks, during this COVID situation, it's a pretty good reflection off of, accessibility to projects and everything based on, whether we've managed to keep advancing the projects when we have travel restrictions, work restrictions. SilverCrest has been successful, and Great Bear has been successful in this because of the jurisdictions and the infrastructure access and other points. So it's something to think about carefully. Is all mining is speculative by nature. You're trying to predict the future based on limited information. But one of the pieces that one of the boxes you can definitely check off is all that additional risk that can come with projects that are in less desirable locations.
Absolutely.
And for us, we're 25 kilometers away from an asset we already built. So just having that social license and understanding of the area and the geology, we're right off a highway. This was a past producing mine from 1880 to 1930, and the average grade was 3 kilos on average, silver equivalent. So, I mean, you've got a nice roadmap there too. So, in Mexico, it's the highest paying jobs of any industry in the country as well. So again, you've got a very celebrated industry in Mexico.
Great. Moving on, share structure, guys. Let's take care of our share structure. Chris Taylor, how many shares outstanding does Great Bear have right now?
Roughly about 50 million shares, Greg, issued and outstanding.
For what you've accomplished, the cash you have in the bank, that's excellent. Management has really managed that very well. Hats off to you guys for doing that. Chris Ritchie, how's your share structure these days?
We've got about 127 million shares fully diluted. And it's been an interesting change. I was quite happy to pat ourselves on the back for adding about $8 of value for every dollar we've spent. And again, I was working on the sell side, and I had a boss back in the day said, we love resource companies because they're great at destroying capital and they need to continue to raise more money. And it was good for the brokers. Until, I was happy with the $8 per dollar spent until I saw Chris's number of $23 or something. So again, when you're efficient with other people's capital, it's important, but it's our own capital as well. We're all heavily invested in our own companies. And for shareholders who are looking at opportunities all over the world and in all sectors, if you're treating your share structure well and you're efficient with capital, that stands out.
You have to remember all the time that you're spending shareholder money. Every dollar that goes out the door until you're a cash flowing company that has production revenue, that's shareholder dollars that you spend. That's some of the best advice I received when I was getting new into running public companies. If you never forget that, you'll never forget to respect your shareholders and try to keep the share counts under control.
That's right. And that's a great point, Chris, because as a newsletter writer, I hate to see when CEOs are traveling around in first class all the time, staying in 5-star hotels on our dime, right? I like how you operate. I've seen you firsthand. I know you are very judicious with investor money. So for lay investors, this is a key point that Chris is making. Yeah. So one other thing I wanted to mention here before we get into the grade, back on the life cycle of a mining share, I wanted to point out where each company is. I don't think I mentioned that. I wanted to point that out to lay investors. Great Bear is more on the first bump. They're going up on that exploration ride. They have a long way to go. I think there's plenty more upside. Whereas SilverCrest Mines is getting ready to ride the next wave, the next bump. They're a fully permitted, you have your feasibility study, Chris, as I understand. And
They'll be ready by the end of the year.
End of the year. So you're in that, basically your stock has performed very well and you have more shares outstanding because you've had to pay for your feasibility and everything, and you're getting ready to ramp up and ride that next big wave. There's going to be a mine. So that just points out, where both companies are, and I think we're going to see plenty more upside as precious metal prices ride higher for both of our panelists today. So next common denominator is grade. I remember Dr. Peter McGaw taught me early on as a newsletter writer. He helped me understand how important grade was to a producing mine. Chris Taylor, you want to take that first?
Yeah, I mean, my background is in mining. I've been involved with putting 3 mines into production. People often mischaracterize it and they say, Chris Taylor put 3 mines into production. No, I was part of the teams that put 3 mines into production. But what you see when you do that is that grade is the ultimate king when it comes to precious metals. And, our project, the Dixie project, is blessed with having high-grade gold that goes right to the surface over a big area. The general context, though, I mean, people, if you're new to the metal investing space, you won't know what high grade versus medium grade versus low grade is. You won't have any kind of clue. I actually had a meeting in New York before all the shutdown happened, and it was a generalist investor who came to me and he was asking, he's like, well, you say you have high grade gold. Does that mean you're drilling 14 karat gold or 24 karat gold? And so his only reference to gold is the jewelry space, right? Whereas if you think about grades and what they are in the gold space, generally low grade gold is sort of a gram per ton or lower. That's generally considered low grade, and high grade in my mind is generally several grams per ton. So 7 or 8 grams per ton or higher. And that's really because an ounce of gold at $1,700 an ounce, or give it an approximate range, each gram of gold should be worth somewhere around $50, US. So if you think about that, it takes money to mine. If you have a gram per ton gold, each ton of rock that you mine could be worth about $50. So that's your total value of each ton. You have to subtract all the mining and processing and operational costs from that, and you can see that you're left with a fairly skinny margin. So for a low grade deposit, you need a really big deposit, and you need to be able to access that cheaply, which means it's going to be on surface and it's going to be bulk tonnage. For high grade deposits, it's a totally different ballgame, because if you're looking at something like, if you're looking at some of the numbers that we've generated recently, we have a lot of material on our project, which is say like a 10 grams per ton, a third of an ounce. So these days you're looking at hundreds of dollars per ton of rock, up to, in our case, we see up to, recently we put out some numbers like half a kilogram per ton. So a kilogram of gold, I mean, these are tens of thousands of dollars per ton, what the rock is worth. And that means you can mine that rock generally down to significant depths, and you can absorb more costs of mining. And people love to have the high grade because it means safety. in terms of production. And what I mean by safety is economic insulation from the fluctuation in gold prices. So big companies, big mining companies, what they love is a lot of high grade ounces, because they know if the prices swing up or the prices swing down, they're going to have those profitable margins no matter what happens to the gold price. The premium deposits in the world are the ones like SilverCrest and like Great Bear that have nice, much better than average grades of the precious metals that they're looking for.
Absolutely.
We've when we put out our PEA, which is our first economic study, it's about a year old now, so there's a lot that's happened since then. If you were to convert all of our silver into gold and come out on a gold equivalent basis, our average grade for the first 4 years is just under 14 grams per ton of gold equivalent.
Mm-hmm.
And again, as Chris mentioned, you have a cost to process each ton, mine and operate, process, and then it's about what comes out the other end. If you can be producing 3-4 times the amount of gold and silver for the same cost, it's your unit costs is really what you want to identify. And again, we're a little further along in terms of work being done, and we were able to come out with a preliminary all-in sustaining cost on a gold basis. And for us, it was $367 per ounce was our all-in sustaining cost. So at today's gold price, you're looking at $1,400 of margin. So we don't want to have investors predicting gold price, silver price by the minute. But when you can make mistakes, when the industry can go up and down, and you're still there making free cash flow, it just allows for a much better risk reward and free cash flow. You can have in the silver space, if you're $12 to $15 all in sustaining costs, you're close to break even. I mean, if you were 350 grams a ton of silver, you would be about a top 25 highest grade mines in the world. For us, our first 4 years were over a kilogram. So again, it's margin of safety, and it's free cash flow, because it takes a long time to bring a mine into production. And if you're worried about dilution and that taking care of shareholder capital, if you can build your second mine and your third mine, all with the cash flows produced from your first mine, you're not coming back to the market. And with skinny margined assets, you can do well if you get huge volatility, but it doesn't mean that cash balance is building up quickly enough to allow for organic growth. So there's a margin of safety that comes with grade that you can't say enough.
Absolutely. And for lay investors, I think the word is leverage. Both of our companies on our panel today offer great leverage for investors as the gold and silver prices go higher. I love high grade because I've been on so many site visits around the world, and I've seen situations where I refer to them as natural earth ATM machines, right? We're just digging money out of the ground. And that's certainly the case for both. It seems like we're both in high grade, very high grade situations for both Great Bear and SilverCrest metals. So at this point, any other points you guys want to make before we get to the question answer session here?
No, I think.
Happy to field some questions.
Yeah, I'm ready to sit some questions as well, Greg.
Okay, let me do this. I'm going to look in my section where the questions come up here.
Hey, Greg, well, this is Knox Henderson with Great Bear. While you're looking, the first question is actually for you. And it was, Greg, what is your general pick list for choosing a mining company?
Yeah, we went through these common denominators. You'll often hear me or other newsletter writers say that when I'm evaluating a company, the company's, it checks all my boxes, right? I have all these boxes, and we listed some of those common denominators. I have some other ones, but again, the management is always most critical. And one other point I'd like to make towards that is that one of the things that I've seen that I've really learned over the years is that the fact that out of all working geologists, only 6% will ever get credit for a discovery that goes on to become a producing economic mine. That means 94% of all the working geologists in the world will work their entire careers and never make a discovery that becomes a mine. And so when you look at that fact, you want to follow the people that have done it before. Chris Taylor's done it before. Chris Ritchie's done it before. The team behind these companies has done it before, not just once or twice, but many times before. I've made money with John Robbins before. Before I even knew Chris Taylor, I already knew I was going to get involved with Great Bear because of John Robbins. I've made money with him. My investors, my subscribers made money. So anyway, that's hopefully that answers that question. But you know, we go through a lot of a checking the box kind of scenario, analyzing all these companies. I probably look at 30 different companies a month. I say no most of the time. All right, there's very few companies that get through my filter system, and Great Bear back in January of 2018 was one of them, and we were at 30 to 40 cents at that point. So next question, Knox, why don't you just read them, Knox?
Sure, yeah, it might be easier. One question here is, thank you for the presentation, very interesting. I'm an investor. What is the market cap of GBR now, and do you see a path to a bigger cap?
So directed at me, I think our
Yes,
market,
Chris, yeah.
yeah, our capitalization in Canadian dollars is about $700 million. That's pretty much factoring in that we have a few million ounces, coming our way on the project. If you think about the per ounce values of other projects in the neighborhood, in the Red Lake area, specifically what they have generated in the past, generally these are, when they get to a bit more of an advanced stage than us, $200 or $300 an ounce tends to be pretty normal. So you could see that as we advance the project, the consensus out there in the independent analyst space right now is that they're expecting us to be able to generate 5 to 10 million ounces or so over the relatively near term on the project the next few years. If that's the case and you value that at a few $100 an ounce as the project gets more advanced, I mean, you're looking at a proposition here which ends up being, somewhere between just over double what we are and, many times what we are. So that tends to be the growth process as you go up that Lassonde curve. You de-risk the project and you see the extra value coming in from the ounces that you're defining. Right now, it's very early stage with the project. We're doing really well, but there's a long way to go.
Thanks for that, Chris. And just to be fair, Chris Ritchie, how do you see a path to a bigger market cap?
We've got a very unique strategy, and that strategy is to get into production as quickly as possible for the smallest amount of capital possible, and then continue the growth of resources, hopefully, while producing. We've only been drilling since early 2016, and in mining terms, that is very, very short period of time. So for us, we've only, in that economic study that's been out in the market, there's only 10 veins of 42. So the resource growth story is similar, that there's still a very, very significant growth potential that's in front of us. And at the same time, we've already crossed that critical threshold to make an economic mine, knock on wood. And while de-risking significantly by having our permits, the team that's done it before, and having, over 160 million US in hand, which is more than the Capex that we actually need, and we're there for drilling as well. So yes, I mean, if commodity price goes higher, if the drill bit for both of our stories continues to be successful, it can go higher. And then the actual cash flow, when we talk about the margin potential here, is another reason that the stocks, both stocks, can go significantly higher.
Thank you.
I mean, Chris is using all the caveats and the disclaimers. I would say SilverCrest becoming a very profitable producer is about a complete no-brainer.
Yeah, absolutely.
The next question, gentlemen, next question for both of you. I'll start with you, Chris Taylor. Comment on metallurgy. As an understanding it for the investment. So the wording here is comment on metallurgy, understanding for investing.
Okay. So metallurgy is extremely important in the mining space, simply because you can generate good grades in a deposit. If you can't extract the metals from it, then you could have a real problem on your hands. And I've seen projects float across my desk over the years that seem to have good grades, but in the end, the gold cannot be extracted. It's usually gold projects that I look at, sometimes copper. You have to show good extractability because if you're only able to extract half of the gold that you see in your rock, you're decreasing all your economics proportionately. In our project, we're doing metallurgy right now, actually, sort of ahead of when we would really need to. We're doing petrography. We can see that the gold that we have is free in the rock, which means it should come out very easily. In the Red Lake area, our district, it's usually 95-96% recoveries of the gold. So it's very good. Basically, the grade you see is the grade that you're working with. I would expect our project to be very similar to that. And Chris can give you a really good rundown on extraction. Sometimes silver's a little bit more complicated. In their case, they have very good extraction on their project as well.
We've been fortunate enough to be actually mining already. Our deposit's very near surface, so we've been able to extract a lot of ore. We have a significant amount sitting on surface. So the tests that we've already done for metallurgy are on real ore. They're not just on small sample sizes, they're on very broad sample sizes across the property. So that speaks to the risk and the risk mitigation that has occurred. And we actually had a pretty fun occurrence happen in that while we were mining, we figured out that there was a bunch of clays that were in the deposit that weren't captured or seen with drilling. And now it's forced us to change the type of mill we're going to build. So again, from a de-risking perspective, it's fantastic to find that out ahead of time. But these clays were actually significantly higher grade than what we were experiencing. So again, our metallurgy has been done to that feasibility level, and it was about 3 to 4% higher than what we originally thought. And the fact that we're already mining some of this ore just helps with that confidence, and then helps making sure that the process that you're building coincides with the type of rock you're dealing with.
Okay, next question. Actually, Greg McCoach, you may want to pipe in on this one. What about share liquidity and its importance to potential investors? How important is liquidity?
Well, yeah, I think is undue shareholder dilution is what I think the person's asking. Mining shares have to, manage their money. They have to be very careful, as we talked about before, of managing their share structure. The higher the share structure gets, the less bang we can get to the upside sometimes. And it's just something that we have to watch. And a lot of times it's expensive to do all the things that we need to do, to drill, to get assays, to permit, to get feasibility studies. And the share structure can get ahead of where we think we should be. So investors should just watch that. Again, that comes back, that's a function of management. The most efficient management teams, both of which are on our panel today, they've done a great job in managing that shareholder dilution. And so, this is just something that's part of the industry. Most of these companies don't have any revenue yet. So in this case, you have to be very careful about managing it. And that goes right to the management team themselves.
I'd add one thing there. The business of managing money has dramatically changed in the last decade. A hedge fund to make 2% of management fees plus 20% of the profits was not out of the ordinary a decade ago. But competition in the financial sector is heavily intense right now with the growth of passive investing in ETFs. So the actual business of managing money has seen huge shrinking of margins. So that means they need to grow. So they're trying to grow their assets under management, but they're not trying to grow their employees. So that means they're trying to put more money to work per idea to create leverage in their own business model. And that means you need greater liquidity to attract a bigger audience. So as you move up the curve of liquidity, more people can look at you. If you're a $3 billion hedge fund and you've got a 50 million market cap company trading $200,000 worth a day, you're just not even on the list.
Right.
So as you migrate north of $1 million, $5 million, $10 million per day, your audience picks up. And again, if you can maintain a tight share structure while you're growing with happy investors, all that marginal buying with that bigger, broader audience can have a huge impact. So again, the greater the liquidity, the bigger the audience. So when things turn around, it can really have an impact.
Yeah, I call that the Hotel California effect when it comes down to liquidity. So, it's a great song. Everybody loves it, but you can check in, but you can never leave. If you don't have the liquidity to get out of your investment, that's something to be careful about when you're investing in companies. Fortunately, our two companies are quite liquid and they trade very nicely.
Absolutely.
Okay, the next question in the precious metal space is this COVID situation going to affect gold and silver production in the months ahead? Maybe
Well,
Greg, you want to start with that in a general sense, and Chris, maybe from your own.
Yeah, I think, you know, everybody's moving forward in the exploration field this year, this summer and fall. I don't see any real changes. Everybody's taking precautions in their business models, but you know, both of you are working in the field. What do you see?
Well, we've had to take precautions to keep everybody safe while basically managing the COVID-19 risk, but we've managed to keep drilling, and that's sort of, you know, if you compare the industry to a bit of a horse race, because we've stayed active and we've kept everybody safe, we sort of come around the corner in the lead, so to speak. But you know, I think coming up, and Chris, I'm sure you're paying attention to this as well, I think you're going to see some financial reporting over the next quarter, which is going to be the second quarter of the year. And that's going to be when all the COVID shutdowns were happening and various mines were going temporarily out of production. I wouldn't actually pay too much attention to that. I think it's just noise. I think the fundamentals on the higher metal prices and the profitable and you know, prudent operation of these companies is going to mean that you might have had a kind of a worse looking Q2, but I think Q3 and Q4 are going to be absolutely phenomenal. So that's my take on you know, how COVID impacted everything. Temporary blip, and I think very good, you know, for the metals industry's profitability towards the end of the year.
One of the ironies here is that if you're a pre-production company, you're deemed to be higher risk, and that's a very fair comment given the risks associated of actually getting up and running. One of the bonuses right now for both Great Bear and SilverCrest is no debt, no committed capital. If we need to slow down for health and safety purposes, we have that full flexibility, and we're using that, and we're using it appropriately to manage health and safety and prioritize that. For producing companies right now having to follow much more stringent protocols to manage health and safety, it means less efficient operations. So some of the margin expansion you would think that would take place because of the move in the commodity prices won't show up in the near term, as Chris just mentioned. So again, I'd hate to be companies with a lot of debt and low margin, and then having to manage the risks with putting people back to work and the social license issues there. So the second part to go with the COVID bit, which is interesting, if you look at the demand situation of everything around the world, it fell off a cliff. Well, gold and silver demand is actually, there's a good conversation to be had there because of what's going on with the paper. So if you're actually having reduced supply while you're having increased demand for the physical commodity itself, I think for gold, we've already seen inflows into the ETF for half of a year that are greater than the last biggest full year of demand. And silver, the expected demand on an annual basis, we're nearing that full year number that was expected, again, halfway through the year. So that supply and demand scenario of a shutdown isn't affecting us the same way it would an oil company right now.
Okay. Actually, you did answer one. The next question was about debt. It looks like neither company has any debt, so that answers that question. And also, a good segue into this other question. How would you rate a gold investment against an equal volume silver investment? How would a mix and blend work best in the world of money creation?
Chris Ritchie, why don't you take that question? You're the silver gold story.
I would just bring it back to very basics when you think of value per ton and margin per ton. And you're going to see a fluctuation between gold and silver to a certain extent. But when those margins are there, that's significant. What you tend to get in silver is silver and lead and zinc. And right now, when you have poor economic conditions, the demand for base metals and more industrial metals can be challenged. So again, if you're looking at gold and silver, or just gold, if the precious metals market takes off, I don't think you need to get too picky there, but I would just be value per ton and margin per ton would be where I'd focus.
Good point.
Yeah, I agree with that assessment as well. Like, focus on the underlying fundamentals. And really, this comes back to our previous argument, typically around grade. So if the company that you're looking at has good precious metal grades, they've got good accessibility, good management, that's really your fundamental choice rather than focusing on the specific ratios of gold to silver.
Yeah.
Okay, thank you, gentlemen. I think we've got a lot of other questions, but you know, in the interest of time, we have everybody's contact information up on the screen. So you know, feel free to email or phone either company or Greg. And Greg, maybe you want to have some closing remarks.
Yeah, let me wrap up. I mean, this has been a very good panel for lay investors. As a newsletter writer, listening to these stories and knowing these stories as I do, I can say that both companies, Great Bear Resources and SilverCrest Metals, are models of efficiency and success. There's not too many companies that are performing like these two. They've done very well in difficult market conditions. And I think the upside for both of these is still tremendous. There's still plenty of exploration potential for both. It's going to be fun to watch both of our companies and to see how things go. But I'm very optimistic that both are going to continue to do very well. Overall, I would just say to lay investors out there, again, sell overvalued bubble markets and come into the undervalued junior mining sector. J. Paul Getty was the one in his autobiography said, if you want to make really big money in investing, you got to be willing to invest when no one cares. You got to buy the stuff that no one's interested in. Well, that's junior miners right now. And then you sell when everybody wants in. And that moment, I think, is coming for this industry. It's going to be a great ride. I think it's going to be a lot of fun, and we're going to make some money. Thank you, everybody, for attending. And again, feel free to contact any of us to answer further questions. Thanks for joining.
Thanks for your time.